Everyone's chasing AI front-end stocks, but the real money may be in the Power Plus data center backbone. What if I told you the biggest AI opportunity isn't the flashy AI stock everyone's already crowding into, but the companies building the boring backbone AI can't live without: power, data centers, and compute capacity? Today we're breaking down two hidden gem AI infrastructure plays: Applied Digital, APLD, and IREN, what they do, what's changed recently, and the risks nobody on Hype YouTube wants to mention. Quick warning, these are higher volatility names. This is not buy now guaranteed. But if you're hunting the next wave of AI picks, the picks and shovels behind the chips, this is where you should be looking. Here's the truth. AI isn't limited by ideas, it's limited by infrastructure. When you hear AI boom, think electricity contracts, high-performance data centers, GPU capacity cooling, plus networking financing to build faster than competitors. If you believe AI demand keeps growing, then the hidden opportunity can be the companies building and supplying the backbone. Our first case study is Applied Digital, or APLD. At its core, Applied Digital builds and operates the specialized, high-performance data centers that are the engine rooms of the AI revolution. Think of them not just as buildings, but as complex industrial facilities engineered for one purpose: housing and powering thousands of energy-hungry GPUs that handle intense AI and other heavy computing workloads. The simple version is this: they're positioning themselves as a critical infrastructure provider, a place where large AI customers can essentially plug in their operations and scale rapidly. For an AI company, building a data center from scratch is a monumental task. It involves years of planning, navigating complex zoning and power agreements, and billions in capital expenditure. APLD aims to solve that problem by offering ready-made, high-density capacity, allowing customers to bypass the construction phase and get to computing faster. This is the data center as a service model, tailored for the unique demands of artificial intelligence. In this capital-intensive industry, progress is measured in steel, concrete, and megawatts. APLD has been aggressively expanding its AI data center build-out, and their recent public updates have been a drumbeat of positive momentum. These updates typically focus on three key pillars that investors watch like a hawk: new capacity coming online, new leasing commitments being signed, and securing the financing to fund it all. This isn't just corporate storytelling, it's the tangible evidence of a business plan in action. Each megawatt energized, each lease signed, and each financing round closed is a step that helps transform APLD from a speculative AI story into a tangible AI cash flow generator. For a company in this phase, demonstrating the ability to execute on its construction and leasing pipeline is paramount. It's the proof that management can convert investor capital into revenue-producing assets. To that end, APLD has been very public about its major campus development projects, such as breaking ground on large-scale AI facilities. In the world of data centers, particularly for AI, the game is all about scale. We're not talking about a few server racks in a basement. We're talking about sprawling campuses, sometimes hundreds of megawatts in size, with their own dedicated power substations and industrial cooling systems. The reason scale is so crucial is that the largest AI customers, the cloud providers and leading AI model developers, require immense capacity. They need to deploy tens of thousands of GPUs in a single location to train their models efficiently. A provider that can deliver hundreds of megawatts and vast amounts of square footage faster than the competition has a significant competitive advantage. Speed to market allows them to capture demand and, most importantly, win the long-term multi-year contracts that form the bedrock of this business model. So, let's break down the business model. APLD is essentially trying to become a specialized landlord for the AI industry. It's a three-step process that, if executed correctly, can create a powerful financial engine. First, they build and own the facility. This is the most capital-intensive part. It involves acquiring land, securing power agreements with utilities, and constructing the physical shell and the critical power and cooling infrastructure. This is the real estate component of their business. Second, they lease that capacity to large customers. These aren't your typical office leases. They are often triple net, or wholesale leases, where the tenant is responsible for most operating costs. The customer brings in their own expensive servers and GPUs, and APLD provides the secure, powered, and cooled space. And third, they lock in long-term contracted revenue. This is the key to the entire model. By signing customers to leases that can span 10, 15, or even 20 years, APLD creates a highly predictable recurring revenue stream. This visibility into future cash flows is what makes the model so attractive to long-term investors and lenders. One of the primary reasons investors have paid close attention to APLD is its success in this third step. The company has publicly discussed securing significant contracted lease revenue, which is directly tied to leasing out capacity at its major campuses. Notably, press releases and market reports have highlighted deals with large, high-profile AI customers like CoreWeave, which lends significant credibility to their strategy and execution. Announcing a multi-100-megawatt lease with a major player is a powerful signal that your facilities meet the demanding technical requirements of the industry leaders. To understand the company's current financial health, we look to their quarterly reports. APLD recently reported its fiscal Q2 2026 results. For anyone doing their own due diligence, the company's investor relations press release is always the cleanest, most direct source for the official numbers for the quarter. When those results came out, several market recaps and analyst reports pointed to a consistent theme. The company is demonstrating rapid, triple-digit revenue growth compared to prior periods. This top-line explosion is exactly what you'd hope to see from a company scaling into a massive market opportunity. However, those same reports also highlighted that APLD is still unprofitable on a net income basis. This isn't surprising. The company is in a heavy investment cycle, spending enormous sums on construction. The translation for an investor is straightforward. APLD is successfully scaling its operations and revenue, but it's still firmly in build mode. During this phase, the focus is less on immediate profitability, and more on growth and project execution. The key metrics to watch are things like megawatts delivered, leasing velocity, and construction timelines. This is a period where operational execution and access to financing matter more than anything else. The profits are expected to follow once these massive long-term assets are fully built and leased. So, let's distill this down to the core bullish thesis for a stock like APLD. It's a simple four-part logic chain. First, the foundational belief is that the demand for AI compute will continue its exponential rise. Every new model, every new application, every enterprise adopting AI adds to this demand. Second, all of that AI compute has non-negotiable physical requirements. It needs immense amounts of power, vast physical space, and highly specialized cooling infrastructure. These are the exact bottlenecks we discussed earlier. Third, the thesis assumes that APLD will successfully execute its build-out, signing long-term leases with major tenants and becoming a key platform that enables the AI industry's growth. And fourth, the conclusion is that those long-term contracts will create highly durable, predictable, and growing revenue streams for years to come, eventually leading to significant profitability and cash flow as the initial build-out costs are absorbed. But no investment thesis is complete without a clear-eyed view of the risks. For a company in APLD's position, these risks are significant and must be respected. First is financing risk. Building data centers is incredibly expensive. APLD needs continuous access to capital markets, both debt and equity, to fund its construction pipeline. A change in interest rates or a tightening of credit conditions could make it more expensive or difficult to secure the necessary funds, potentially slowing growth. Second is execution risk. This is the operational side of the coin. Large-scale construction projects are notoriously complex and prone to delays, supply chain disruptions, and cost overruns. Failing to deliver a facility on time could jeopardize a major customer lease and damage the company's reputation. Third is customer concentration. While signing a massive lease with a single large tenant is a huge win, it also creates risk. If a very large portion of your contracted revenue comes from just one or two customers, any financial trouble or change in strategy from that customer could have an outsized negative impact on your business. Diversifying the customer base over time is key to mitigating this. Finally, there is dilution risk. As a growing company that needs capital, APLD may issue new shares to raise money. While necessary for funding growth, this action increases the total number of shares outstanding, which can dilute the ownership stake of existing shareholders and put pressure on the stock price. Putting it all together, APLD is a clear example of a high-growth, high-risk play on the AI infrastructure boom. This isn't a set-it-and-forget-it blue-chip stock. It's a watch-the-milestones quarterly stock, where each earnings report and project update provides crucial data points on whether the company is successfully navigating the risks and executing on the massive opportunity ahead. Our second case study is IREN, a company that offers another angle on the AI infrastructure thesis. IREN began its life as a major Bitcoin miner, securing vast amounts of power capacity to run the specialized computers, or ASICs, needed for crypto mining. But the real story, and the reason it's on investors' radars, has been its strategic pivot. The company is leveraging its foundational infrastructure, its access to power, and its operational expertise in running large-scale computing facilities to serve the exploding demand for AI cloud and high-performance compute services. This isn't just a change in marketing, it's a fundamental shift in the company's business model, moving from a volatile, commodity-driven industry to a high-growth, service-oriented one. The core asset is the same: large-scale, low-cost power. The application, however, is evolving from mining digital currency to powering artificial intelligence. This transition was thrown into sharp relief with IREN's fiscal second quarter 2026 results, which became a major talking point on Wall Street. On the surface, the headlines were mixed. Reports highlighted that the company's total revenue and earnings per share missed consensus analyst expectations. Digging into the details, however, revealed a crucial divergence. The weakness was almost entirely tied to the legacy crypto mining side of the business, which is subject to the volatility of Bitcoin prices and mining difficulty. But the real story was in the other column. The segment that investors are focused on, AI services, was showing significant strength and rapid expansion. This is a classic tale of two businesses scenario, where the legacy operations are masking the growth of the new, strategic venture. The market is trying to decide which narrative will define the company's future. In fact, one of the most important lines buried in multiple analyst reports and company filings was this: AI cloud revenue increased sharply year over year. Even if the absolute number came in slightly below some of the more aggressive forecasts, the trajectory was undeniable. This is the proof point investors were looking for, evidence that the pivot isn't just a plan on a slide deck, but a tangible, revenue-generating business. For a company in transition, the rate of change and the direction of growth can often be more important to the market than hitting a specific quarterly number, especially in a nascent division. So, why do investors care so much about this shift? It comes down to unit economics. The revenue and profit margins generated per megawatt of power are potentially much higher for AI workloads than for Bitcoin mining. If IREN can successfully reallocate more of its power capacity from mining to these higher-value AI services, the company's entire financial profile could change dramatically. Think of it like a factory owner who has been making low-margin widgets, who suddenly has the opportunity to retool the same factory floor to produce high-margin, in-demand electronics. The fixed costs are similar, but the potential for profitability is on a completely different level. This is why the IREN story is not just about AI hype. It's a tangible business case rooted in power infrastructure and strategic capacity allocation. The company has already done the hard work of securing land and, crucially, long-term power agreements. Now the challenge is to deploy the capital and operational know-how to maximize the economic value of every megawatt they control. This strategic pivot has been underpinned by significant developments. Recent coverage has extensively discussed IREN's AI ambitions in connection with a large-scale agreement, often described as a multi-year, multi-billion-dollar arrangement with a major player in the AI space. Alongside this, you'll see references to the massive capital investment required, including specific GPU financing facilities. Securing not just the customer, but also the financing to procure thousands of high-end GPUs from suppliers like NVIDIA is a critical piece of the puzzle. These announcements are what give the market confidence that the transition is well underway and backed by serious commitments from both customers and capital partners. Now, it's crucial to interpret this correctly. A big contract doesn't translate to guaranteed profits overnight. The market views this as a show-me story. The opportunity is clear, but the key question is one of execution. Can IREN build out its data centers, install these complex systems, and bring the capacity online fast enough to meet its contractual obligations and satisfy investor expectations. The stock's performance will likely be tied to milestones, how quickly they can convert signed deals into active revenue-generating megawatts. Of course, no investment thesis is complete without a clear-eyed look at the risks, and the bear case for IREN is also straightforward. First, a significant portion of the business is still exposed to the unpredictable and often brutal crypto cycles. A prolonged downturn in Bitcoin's price could negatively impact revenue and cash flow from the mining segment, potentially complicating the financing and execution of the AI pivot. Second, execution risk is paramount. The AI ramp-up can be slower, more expensive, and more complex than investors expect. Building data centers at this scale is a massive logistical undertaking. Delays in construction, power grid connection, or hardware delivery can push revenue timelines out, leading to disappointment. Third, scaling the AI cloud business requires enormous amounts of capital for GPUs and infrastructure, alongside flawless operational delivery. Any misstep in managing this capital expenditure, or in the technical execution of bringing capacity online, could damage the company's reputation and financial standing. And finally, because the investment story is so forward-looking, the stock can be highly sensitive to company guidance. Management may set aggressive targets to signal confidence, but if they miss those targets, the loss of credibility can be more damaging than the financial miss itself. For all these reasons, you'll see a sharp divide among analysts and market commentators. After the stock makes big moves, some will argue it's gotten ahead of itself and priced in perfection, while others will maintain that the market is still underestimating the long-term value of the AI transition. This polarity is characteristic of a high-stakes transformation story like IREN's. If you're going to play higher volatility AI infrastructure names, don't do it like a gambler, do it like a portfolio builder. Rule 1, DCA beats ego, start small, add on confirmed progress. Rule 2, track milestones, new leases, expansions, APLD, AI revenue ramp, plus capacity allocation, IREN. Rule 3, respect risk. These can move 10-20% fast in either direction. So, let's bring it all together. The AI revolution isn't just about smarter algorithms and large language models, it's a physical world phenomenon demanding unprecedented amounts of power, cooling, and real estate. While the market fixates on the chip designers and software platforms, the real, tangible bottleneck is emerging in the infrastructure layer. This is where the digital world meets the physical, and it's the investment thesis we've explored today. To track this thesis, you need to look beyond the headlines and dig into the operational metrics. Here's what I watch quarterly for APLD. First, lease updates. Who are they signing, for how long, and at what rate? These long-term contracts are the bedrock of their future revenue. Second, build progress. Are their construction timelines on track? Every megawatt brought online is a new stream of cash flow. Third, financing terms. Building data centers is incredibly capital-intensive, so I'm watching their cost of debt and any potential shareholder dilution. And finally, the revenue growth trend, which tells us if their execution is matching their promises. For IREN, the story is about a strategic pivot, so I'm focused on the AI cloud revenue trajectory. How fast is that new segment growing, and is it offsetting their legacy crypto business? Next, power and capacity expansion. Their access to low-cost energy is their core advantage. So, I track how many megawatts they're adding and at what cost. Finally, I analyze how this pivot impacts total revenue and, more importantly, their profit margins. Is the AI cloud business more profitable and stable? That's the key question. Right now, everyone is fighting over the same handful of headline AI names, pushing valuations to dizzying heights, but the next phase of this build-out won't be one on software alone. AI's next bottleneck is infrastructure. And that's the less crowded foundational arena where these two companies are trying to win. Both APLD and IREN offer a unique way to invest in this theme, but they come with very different business models and risk profiles. If you want a deep dive follow-up video comparing them head-to-head, looking at their balance sheets, upcoming catalysts, and the biggest red flags to watch for each, let me know. Just comment AI backbone below, and if there's enough interest, I'll build that breakdown for you.
This video is for educational and entertainment purposes only and is not financial advice. I'm not a financial advisor. Investing involves risk, including loss of principal. Do your own research, review company filings, and consider your risk tolerance before investing. Past performance does not guarantee future results. This video is for educational and entertainment purposes only and is not financial advice. I'm not a financial advisor. Investing involves risk, including loss of principal. Do your own research, review company filings, and consider your risk tolerance before investing. Past performance does not guarantee future results.